I want to welcome you guys to a complete, comprehensive guide to dividend investing. If you are seeking a reliable strategy to generate income and grow your wealth, dividend investing can be quite a powerful tool in your financial arsenal. Now, by investing into dividend-paying stocks, you can benefit from regular cash payments, while potentially participating in the company's growth as well. Dividend investing offers the best of both worlds, income and growth. And while traditional investment strategies focus solely on capital appreciation and then withdrawing the money slowly throughout retirement, dividend investing allows you to generate a steady stream of income from your investments. And whether you are a seasoned investor or a newcomer to the world of finance and investing, this step-by-step guide will equip you with some of the basic knowledge and tools to succeed in dividend investing. Now a little bit about myself. I'm personally a 7-figure investor and bought my very first dividend stock ever around 7 years ago. And years before I even bought my very first dividend stock, I remember being very interested in the idea of dividend investing, but found myself not knowing where to start and asking myself simple but yet important questions like, what even is a dividend? Why do stocks pay dividends? How often do these so-called dividends get paid out? And how can I get my hands on some of these dividend payments? Now, if you are finding yourself asking some of these questions, or maybe all of them, and want to know pretty much all there is to know, or at least the basics about dividend investing and how it works, well then keep watching. And for those interested in seeing my actual dividend portfolios live on this video, stay tuned until the end of this video because we are going to go over my exact real holdings in one of my largest dividend portfolios, which is currently valued at around $500,000. And on top of that, I'm going to show you exactly how much this portfolio generates in dividend income for me on a monthly basis. So let's start from the beginning. What actually is a dividend? So a dividend is a distribution of a portion of a company's earnings or profits to its shareholders. When a company generates profits, it has several options on how to utilize these funds. One option is to reinvest the profits back into the business for expansion, research and development, or debt reduction. Now, another option that the company has is to distribute a portion of these profits to the shareholders in the form of dividends. Dividends are typically paid out in cash, but can also be paid in additional shares of stock or other assets on top of that. Cash dividends are the most common form and are usually distributed on a regular basis. Most companies pay dividends on a quarterly basis. Many companies also pay a monthly dividend, but some companies pay a dividend semi-annually or even once a year. The amount of these dividends is going to be determined on the company's board of directors, and it's based on various factors including the company's profitability, the company's financial health, growth prospects, and cash flow. When a company declares a dividend, it announces the amount to be paid per share of stock and sets a dividend payment date. The dividend payment date is the day when the dividend is actually distributed to the shareholders of record. Now, one question I had at the beginning of my dividend investing journey is, when do I have to invest into a stock in order to receive the next dividend? So to be eligible to receive the forward dividend payments, an investor must own the stock on the record date, which is typically a few days before the payment date, and some companies have a bigger or lesser gap. The record date is determined by the company and often disclosed in advance. So if you want to be eligible to receive a dividend from a company, make sure you own shares of whatever stock or ETF it is on or before that date. Dividends are often expressed as a dividend yield, and this is something else that really confused me at the start of my investing journey. The dividend yield is the annual dividend payment per share divided by the stock price. So for example, let's use a really easy example. Let's say a company pays an annual dividend of $2 per share and the stock price is $50. The dividend yield would be 4%, or $2 divided by the $50. Dividend yield is an important metric for income investors, as it definitely helps assess the income potential of a stock relative to its price. And as you get more and more involved into your dividend investing journey, you're going to find yourself looking at stocks and ETFs, and a lot of times the first thing you're going to want to know is, how much does X, Y, or Z stock yield? Because you're of course going to want to know how much you're going to make off your investment. Dividends are considered a return on investment for shareholders. They provide investors with a way to benefit from the company's profitability and share in its success. Dividend-paying stocks are often favored by income-oriented investors who seek a regular income stream from their investments. It is important to note that not all companies pay dividends. Some companies, especially younger or high-growth companies, may choose to reinvest most of their profits entirely back into the business to fuel expansion and innovation. So keep in mind, it's important to note that not every single company in the stock market and not every single ETF does offer a dividend, but there are quite a few that do. Therefore, investors interested in dividends need to specifically seek out dividend-paying stocks. Dividend investing can offer several advantages, and some of these advantages are a steady income stream, which can be particularly attractive for older investors closer to retirement, or individuals seeking regular cash flow. Dividends can also contribute to an overall return on investment, as they can enhance the total returns of the stock through both income and capital appreciation. Now, what I mean by that is, let's say you invested into a dividend stock that was $100 per share when you bought it. By the end of year one of you holding onto this stock, let's say the stock went up $10, but also paid $5 per year in dividends. You would now not only be looking at the $10 increase as a capital appreciation on your investment, but also the $5 dividends. So in total, you would have a $15 total return on your investment after year one. Now, additionally, dividends can provide a degree of stability and reliability, as companies that consistently pay dividends are often financially sound and well established. You're going to find that a lot of companies, especially companies that have a long-term track record of paying dividends, companies like Coca-Cola, like McDonald's, just to name a few. Companies like this are, for the most part, very large and, generally speaking, financially sound and definitely well established. So now that we went over some of the basics of what a dividend is, let's talk about some of the things to be aware of when it comes to dividend investing. And one of the most important things, in my opinion, to be aware of is chasing high-yielding dividend stocks. Now, certain stocks and ETFs out there are going to offer a very high starting yield. And when investing into these high-yielding dividend stocks or ETFs, there are several factors to be aware of to make sure that you're making an informed investment decision. And while high-yielding dividends may seem attractive, especially to newer investors, and let me tell you, when I first got started, I was investing into high-yielding dividends like crazy because I figured, why not? They're offering way higher yield, which means, in theory, you're going to get paid more per year. But that's not always the case. Let's go through a few of the reasons on why high-yielding dividend stocks or ETFs can be dangerous. So first, some of these high yielders can have an unsustainable dividend. It's important to be cautious of companies offering exceptional high yields that seem too good to be true. Dividend investing is pretty much like anything else in life. If it seems too good to be true, it probably is. A significantly higher yield compared to the industry standard may indicate an unsustainable dividend payouts. So even if a company is paying out a massive yield, let's say a 10%, 12%, 15% dividend yield, it doesn't mean that it's going to stay forever. A company's ability to consistently generate sufficient earnings and cash flow to cover a dividend payment is what's crucial here. Examine the company's financial health, payout ratio, and dividend history to assess the sustainability of the dividend. And again, like anything, there can be outliers, but that's something to take seriously. Also, when it comes to high-yielding dividend stocks, you could see dividend cuts in the future. High-yielding dividend stocks can be vulnerable to dividend cuts. Companies may reduce or even eliminate dividend payments due to financial difficulties, changing business conditions, or the need to reinvest the profits for growth. Generally speaking, most of the time, when companies are offering a very high yield, they could be at risk, or at least more at risk, of dividend cuts in the future. And let me tell you, there's nothing more unfortunate than when a company is paying out a nice big dividend and all of a sudden you get news that the dividend has been reduced by half or even suspended all the way. Now, high-yielding dividend stocks often also come with higher risk because the market may view these stocks as a riskier investment, causing their stock price to decline and decay over time. Companies with high dividend yields may be in sectors facing challenges. They may be companies with higher debt levels or operate in volatile industries. Some higher-yielding stocks or ETFs may offer limited growth potential. Companies with higher dividend payouts may allocate less capital towards growth initiatives or reinvest in the business. So companies that have higher yields, they might be paying out the majority of profits or even taking out debt to pay their shareholders dividends. Now, this is most likely not going to be something that you're going to want to be invested in long term. Like I said earlier, it might be fun and it might be exciting to receive a large dividend payment from a high-yielding dividend stock or ETF, but keep in mind there's many risks involved. So now that we went over the basics of what a dividend is and what maybe to look out for when it comes to higher yielding dividend stocks and ETFs, let's talk about the differences between investing into growth stocks and dividend stocks, because this is also very important to know if you're a newer investor. Investing into growth stocks and dividend stocks represent two distinct approaches to investing, each with its own characteristics and objectives. Let's go over some key differences between the both of them. So as far as growth stock investing, growth stocks are primarily focused on capital appreciation and the potential for substantial growth in the company's earnings and stock price. These companies typically reinvest their profits back into the business to fund expansion, research, development, and other growth initiatives. So think of a company like Amazon. Amazon is most focused on growth and making the company bigger and bigger, bringing in more and more year-over-year revenue and reinvesting all the potential revenue and profits in order to make the company and the stock price grow long-term into the future. Now with growth stocks, you're not often going to find that they pay a dividend, or in some cases they may pay a very low dividend. For example, there's some companies, some stocks in the tech sector that do pay a dividend, but it's maybe under 1%, something like Apple. So instead of paying a dividend, these companies, these growth stocks, choose to reinvest their earnings for future growth potentials. Again, their focus is growing the share price of the stock. Now with growth stocks, it's important to note that there's likely going to be more volatility. Growth stocks tend to be more volatile and experience larger price swings compared to dividend stocks. Their share price are driven by market sentiment, investor expectations, and the company's growth prospects. This volatility can present both opportunities and risks for investors. Now, this was the main reason why I was more driven to dividend investing from the start. I would consider myself more of a conservative investor. I'm not looking to get rich overnight or even in a few years. I'd much rather find an investment vehicle or strategy which can offer me great wealth long-term into the future. That's why dividend investing was better for me. Investing in growth stocks carries a higher level of risk. Companies in the growth phase may be subject to market uncertainties, increasing competition, technological disruptions, or changes in consumer preferences. The potential for high growth can also attract speculative investors, leading to increased volatility. And lastly, when it comes to investing into growth stocks, valuation is important. Growth stocks are often valued on their future earning potential rather than their current earnings. Investors analyze metrics such as price to earnings or PE ratios, price to sales or PS ratios, or other valuation measures to assess their attractiveness relative to their growth prospects. So now going over some of the characteristics that make up dividend stocks. Dividend stocks prioritize generating a steady stream of income for investors. These companies typically have a history of consistent earnings and choose to distribute a portion of their profits to shareholders in the form of dividends. Dividend stocks are often sought after by income-oriented investors who are much less concerned with the long-term capital appreciation like you would find in growth stock investors. Dividend investing often offers more stability and less volatility compared to something like growth stocks. And this is because companies that consistently pay dividends tend to have a more established business model, stable cash flows, and strong financial positions that investors can sort of count on, which makes investing in dividend stocks much less stressful in my experience. Also, with dividend stock investing, there's more of a long-term approach. Investors focus on sustainability and growth potential of the dividend payments over time, rather than the short-term price fluctuations, which also, in my experience, makes dividend investing much less work compared to growth stock investing. Now, when it comes to valuation for dividend stocks can sometimes be valued based on their dividend yield, which represents the dividend payments as a percentage of the stock price. Investors compare the dividend yield of a stock and other income-generating instruments to assess its attractiveness. A higher dividend yield may indicate a higher income potential relative to the stock price, but also remember, higher dividend yield doesn't always mean it's a better investment. So now that we have some of the basics down, let's go to one of my favorite websites and show you how I personally enjoy researching different dividend stocks to figure out which investment is right for me. So right here we are on seekingalpha.com, and I'm not sponsored by them or anything, but I do enjoy this website. There's plenty of different other research websites out there, but Seeking Alpha is pretty decent. I think there is a paid version of seekingalpha.com, but I just have the free version. So when it comes to seekingalpha.com, here's the home page right here. You can go up here and type in any stock with any ticker symbol and be able to research the company in some great detail. So for example, if we want to look into something like SCHD, the Schwab US Dividend Equity ETF, you click on it right here and it brings you to the summary of SCHD, where you can look at things like how the stock has done in the last day, the last month, all time, etc. You also can look at some pretty interesting metrics, like how the ETF or stock has performed over the last 52 weeks, how it's performed throughout the day, the ETF in this case expense ratio, which is how much the fund charges you to own it, the dividend frequency of whatever instrument you're looking at, the dividend rate, which is how much the stock or ETF pays out on a yearly basis, the AUM or assets under management, which is how much money is in the fund, and of course the trading volume. So from here on seekingalpha.com, once you're in on whatever stock or ETF you want to look into, you can go to things like holdings and see the exact breakdown of whatever you're looking at. So once again, for this example, for SCHD, you can see the breakdown of all the different sectors on a percentage basis to really get an idea of what you're investing into. You can also see things like the top 10 holdings. So in this case, these are SCHD ETF's top 10 holdings. And once again, what percentage of holdings they are in relative to the fund. Now, one of my favorite tabs when it comes to doing research for dividend stocks and ETFs on seekingalpha.com is this right here, the dividends tab. So if you click right here on dividends, you can see right here all the information you're going to need to know when it comes to investing into ETFs or stocks, of course. At the top, you can see right here, it shows you the dividend yield, the trailing 12 months, which is the sum of actual ordinary cash dividend payments in the last 12 months. And then, of course, you have dividend growth rate, which is how fast the stock or ETF raises their dividend over time. You have the 3-year growth rate, 5-year, 10-year. You have the amount of years of consecutive dividend growth and the consecutive years of dividend payments. If you scroll down, then you can see the dividend summary. So down here, it shows you the trailing 12-month dividend yield. It shows you the annual payout amount. It shows you the payout ratio if there is one. It shows you the 5-year growth rate, dividend growth rate. And then it shows the last announced dividend right here, the ex-dividend date, which is important because you need to know these dates to know when you are going to need to own the shares of whatever stock or ETF you're looking to buy into to get the next dividend. You have the payout date, the record date, the declaration date, and the dividend frequency. If you scroll back up to the top, you can go through here and see things like dividend history, where it will show you how many years in a row that a stock or ETF has paid their dividend, how much they paid every single quarter or month, etc. And if you keep scrolling down, you can see the entire dividend payment history for whatever stock or ETF you want to look at. Now, one of my other favorite tabs when it comes to seekingalpha.com, and one that I use quite a bit, is right here. It's called charting. So this is pretty cool because you can chart out different stocks and ETFs against each other. And you can use different metrics like price return, total revenue, EBITDA, and all kinds of other metrics. So if you were to look at total return, for example, which is the share price plus the dividend included, and stack up SCHD or other names next to the S&P 500, you can see which has done better over the last 1 year, 3 years, 5 years, 6 months, etc. This gives you a really good idea and a really nice visualization, pretty simply, to see how good X, Y, or Z investment has done compared to the general market. So now that you understand the basics for Seeking Alpha, and again, you don't need to use seekingalpha.com, that's just my specific favorite dividend investing tool, but there's tons of others out there. Let's go over some common dividend investing questions and see if I can answer some of them. So one of the common questions is, how do I find dividend paying stocks? So there are really several ways to find dividend paying stocks. You can start by researching companies in different sectors that are known for paying dividends, such as utilities, consumer goods, or real estate investment trusts known as REITs. Financial websites like Seeking Alpha, MarketWatch, there's tons of them out there. They can help you because the more you're on them, the more you kind of just click around and get lost in it, the more you're going to uncover. It does take time, but it's not all that difficult. Another good question is, what should I consider when selecting dividend stocks? So when selecting dividend stocks, some of the things that I consider are things like the company's dividend payment history, the company's financial health, how much the company's bringing in revenue per year, is the amount of revenue going up or down, how much of that revenue is profit, the company's payout ratio, industry outlook for the company, and of course things like competitive position. Is the company going to be here for a while? Do you think this stock is going to outlast you? Also things like track record of consistent dividend payments, sustainable dividend yields, and things like that. Another good question is, what is diversification and should I use it in my portfolio? So diversification is having different investments throughout the markets and not putting all your eggs in one basket. Diversification is definitely key to reducing risk in any investment portfolio. In dividend investing, though, you can diversify by investing into dividend-paying stocks from different sectors, industries, and even different geographical locations. Additionally, if you want to be very diversified, you can invest into things like exchange-traded funds or ETFs that have a diversified basket of different dividend stocks. Diversification is definitely key. It's once again not something that I really did enough of when I first started investing, but now, as you're going to see here in a few minutes, my portfolios are heavily diversified. Another good question is, can dividends be reinvested? So once you get paid the dividend from whatever company or ETF, can they be reinvested? And the answer is yes. Many companies offer dividend reinvestment programs. Certain brokerages offer them too, which basically allows you to automatically reinvest the dividends that are paid out by whatever company or ETF into additional shares of it. And this, of course, can help accelerate the growth of the investment portfolio very quickly. Another great question is, are dividend payments guaranteed? And this is important because dividends are not guaranteed. Companies can reduce or suspend dividend payments if they face financial challenges, or if companies decide to reinvest their earnings back into the business. It's important to assess a company's financial health and dividend sustainability before investing into a company for their dividend. And again, this part is going to take some practice and a lot of research. You're going to need to really try your best to decide which companies are going to have the safest dividend outlook and which companies are going to generate the largest total return. Another common question when it comes to dividend investing is, of course, taxes. So when it comes to taxes, this is going to be a case-by-case basis because everyone has a different situation. And I'm definitely not an accountant, but dividend income is generally taxable. The tax rate on dividends depends on factors like your income level, the type of dividend, whether it's a qualified or non-qualified dividend, and of course, different countries' tax laws. But please take the time to consult a tax professional or refer to tax guidelines to find specific information. So now that we went over some of the common questions when it comes to dividend investing, let's talk about some of the common mistakes that newer dividend investors often find themselves in. One of the most common mistakes that dividend investors find themselves in is chasing high dividend yields. Now, buying into a dividend stock or ETF, solely focusing on the highest dividend yield without considering things like underlying fundamentals of the company, extremely high yields, is definitely something a lot of newer investors do. And as we talked about earlier, extremely high dividend yields can be a clear warning sign of an unsustainable dividend, or simply put, most likely underlying issues with the company. Another common mistake that dividend investors make is ignoring dividend sustainability. Investing in dividend stocks without evaluating the company's ability to sustain or grow the dividend payments can be very, very risky. Analyze the company's earnings growth, the cash flow, payout ratio, and other metrics to figure out if a company does have or doesn't have a sustainable dividend ahead. Another common mistake is neglecting dividend growth. Overemphasizing the current yield and overlooking the potential for dividend growth in the future is a major, major mistake. Dividend growth is crucial for maintaining purchasing power over time, especially in the face of inflation. Looking for companies and ETFs that might not have the largest starting dividend yield, but can grow their dividends quickly and have over the long term is very important when getting started. Another mistake is lack of diversification. Failing to diversify dividend stock holdings can expose investors to undue risk. Concentrating investments in a single sector or putting all their money into a few individual stocks can increase vulnerability to industry-specific risks or adverse company-specific events. Diversity across different stocks and sectors can mitigate risks and protect your portfolio during downturns. A few more mistakes that investors typically make is focusing solely on dividends. While dividends are a key component to dividend investing, of course, it's important to consider things like overall investment thesis, beyond just the income generated from dividends. Evaluating the company's growth potential, competitive advantage, market position, and other things can be just, if not more important, than the dividend a company or ETF is currently offering. And lastly, one of the common mistakes is emotional decision making. Making investment decisions based on short-term market fluctuations or succumbing to emotional biases can hinder long-term success. Avoid reacting impulsively to temporary market downturns or chasing the latest market trends. Maintain a disciplined investment strategy, focus on company fundamentals, and have a long-term outlook. So next, what we are going to do is look through one of my largest dividend stock portfolios that's currently valued around $489,000. This portfolio is made up of over 20 different stocks and ETFs, and in my opinion is pretty well diversified and crosses off pretty much everything in line with my dividend investing strategy. So now to go over some of my largest holdings. I have 1,661 shares of the BDJ ETF, the BlackRock Enhanced Equity Dividend Trust. I have 1,091 shares of Devo, the Amplified Enhanced Dividend Income ETF. I have things like 1,000 shares of Verizon, 1,000 shares of Apple stock, 820 shares of QYield, 715 of NewSea. I have 671 JEPI shares in this portfolio, over 640 shares of Realty Income, 630 shares of EPD, 503 of BST, 442 of MPW, ETJ, 419 shares, and so on and so forth. Now, like I said earlier, I do have other portfolios across multiple brokerages because I don't like to keep everything on one single brokerage. But this right here is one of my largest dividend stock portfolios. Now, what's also pretty interesting to see is exactly how much this portfolio generates on a monthly basis. Now, this is just an estimator because, of course, all these different positions are going to likely change how much they pay on a monthly or a quarterly basis over time. But as of right now, this portfolio brings in just over $2,000 per month. So there you have it. I really hope you guys enjoyed this thorough breakdown of pretty much everything you need to know as far as the basics go for dividend investing, all the mistakes that are common, and hopefully some of the answers to some of the most frequently asked questions. I really enjoy making content like this because I wish I watched something like this when I first started dividend investing, in the hopes of not making all the mistakes I made at the beginning of my investing journey. If you did enjoy this step-by-step guide and want to see more videos about dividend investing in the future, make sure to please drop a like in this video and subscribe for more. Thanks for stopping by once again, and I'll see you in the next one.